My panelists said that we were the warm-up act, and I'm thinking we're just doing the best first to kick us off to have a good day. So please help me in welcoming Max Levchin, the CEO and founder of Affirm. Max, it's great to have you here. Of course, we all know you as an early tech investor, but of course, one of your latest ventures has been Affirm. And I first want to ask you, how did you get the idea?
So between the bookends so far of my trip down the memory lane of fintech has been obviously PayPal and this thing. And at PayPal 20 years ago, a very much younger version of Max Levchin tried to apply for credit. And being a fresh off the boat immigrant at that time, I was declined right, left and center, and eventually had, I think Peter co-signed for my first car, and another early PayPal guy co-signed for my first phone. And so the embarrassment of, I have a good job, I have a good education, I can't get any credit anywhere in this country, stayed with me. And so, almost 20 years later when we started Affirm, the driving force at the very beginning was there are lots of people like me that just should absolutely have access to credit, don't get it, they deserve it, but they're excluded. So the root cause, of course, is the credit scoring models used by traditional lenders, traditional banks were built a long time ago, and they don't really take full advantage of the information available, therefore do not serve a whole lot of people. There are 11 million Americans that are credit invisible. There are 40 million Americans that have catastrophic, quote-unquote, errors in their credit reports. So the original impetus was really to just, let's go fix the credit scoring problem because there's so many people who are excluded. As we dug in, we realized two things. One, many people, especially young people, are actively opting out of credit cards. And so this idea of, hey, let's build a better credit score morphed into this idea, let's build a better lending product because people want to buy things, but they're actively putting their plastic down and saying, I don't trust this thing. The price of credit, total price of a purchase is just not something I can estimate, and so I'm not comfortable being in this forever debt.
Right.
The other one is that as we try to sort of investigate that insight more and more, we realize that there are plenty of merchants that are saying, I would like to offer my buyers an alternative, something that actually works for them, works better than a credit card. And so we started from a kind of a nerdy math and science project, hey, let's do a better credit scoring system, ended up building an entirely new payment model, which we think has certainly resonated with a lot of people at this point.
So talk to me more about how your business model works.
So Affirm is an alternative payment provider service. We are offered at the point of sale. We've partnered with several thousand retailers at this point. The largest one is Walmart. The smallest one you've probably not shopped at yet. And we offer an alternative to credit cards that appeals to consumers fundamentally for the very, very, very crispness and clarity of cost. So when someone says, that's a $2,000 bicycle frame, I really like it, but if I put it on my plastic, I'm gonna revolve. Every time I buy a latte or a lunch, it's just gonna add to my interest. I have no idea when I'm gonna be out of debt. I'm not gonna buy it. That merchant loses that sale. We approach the problem from the outside saying, well, what if we told you that the total price will be this many dollars, we're going to turn it into 12 payments of that many dollars divided by 12, and that's it. Total clarity, exactly when you're done paying it off. You can't revolve, you can't refinance your own debt. It's super, super simple, super, super clear, and most importantly, there are no fees of any kind. There's no hidden tricks. The way credit cards work fundamentally is, among other forms of fees, there are plenty of hidden ones. And so when you least expect it, there's oh, wait a second, that interest that we told you we're not gonna compound, sorry about that, it changed, now we're gonna compound. And so that's what the young buyers are basically protesting against. We offer a product that says super clear, super predictable, when you're done paying, you're done paying, there's nothing else to do. And so that results in significant sense of confidence and clarity for the buyer. Most Affirm merchant partners report a near doubling of the AOV, of the average order value, because consumers feel more confident that they can buy, afford, and not be in debt after a very short period of time. On the flip side, consumers seem to like us as well. We have a Net Promoter Score of 83, which is, I think, the very highest in the industry, which we're proudly somewhat ahead of Amex, which is kind of the gold-plated brand in our world.
You talked about the younger buyer. Who are your customers, and how do you make sure that you target the right customer for your business?
Our customers are fundamentally the customers of the merchants that we partner with. Affirm appeals from, at this point, many millions of customers served to a younger demo. So about 67% of our customer base is Gen X and younger, and sort of, I would say probably evenly distributed between Gen X and millennial, maybe slightly skewing millennial. At this point, post-millennials are entering the buying fray. So that's the kind of demographic. The buyer is typically someone who feels that they're deserving of credit. We will not lend money. Part of our model, one of the things that's actually pretty important is to point out, we don't charge any fees, including late fees. So if you're late, we will remind you, but we won't make money. And it's a fairly important stance for us. We want to make sure that we are aligned fully with the customer. If they're on time, we'll make money. If they're late, we lose money because time is money. And so the people that this value proposition appeals to are fundamentally younger, more idealistic perhaps. They believe that they want to be responsible. They don't want to borrow money if they can't. They appreciate the clarity and the control and certainty of, we will underwrite you, we will tell you how much we can lend to you responsibly and when we have to stop. So the relationship that we've developed with our buyers are, really authentic and, to be honest, refreshing, because most of the time you hear of consumers hating their financial institutions.
Right.
Ours tend to love us.
There's been a lot of talk, though, and it seems to go against a little bit of what you've said about that generation's in a ton of debt. They can barely afford their student loans. They can't buy homes. What do you say to critics that say your business model is perhaps just perpetuating the increase in debt that these people can't pay back?
It's actually quite the opposite. The reality of our life as consumers is you have to use credit. Credit and debt are two sides of the same coin. Debt is bad, credit is good. Credit is what you use to borrow money to invest in a better future. You borrow money to go to school so that you can have better earning capacity, borrow money to buy a suit so you can pass that job interview. So all those things are generally good uses of credit. And then, of course, you find yourself unable to pay it back, and suddenly you're in debt and the spiral of debt. And so I would argue non-revolving credit models are fundamentally better than revolving. This is probably a somewhat controversial thing to say, but if you compare the business model of a credit card to the business model of a payday loan, the only real difference is the rate. Mm-hmm. If you're allowed to perpetually refinance your own debt, you don't pay it off now, pay it off later, that is how payday lenders make money. They just tend to charge significantly higher rates than credit cards. Credit cards are not exactly cheap rates either. The difference with Affirm is we enter the conversation by saying, look, we want to give you a very clear time when you're done paying it off. In fact, we're going to make it a requirement. When we click on this contract together and say, we will lend you money to buy the suit so you can go have that interview experience, we expect it done in 12 months. Mm-hmm. And after 12 months, you're in arrears. It is not let's make it 24, let's make it 36. We don't allow refinancing of your own debt, which pushes people to be more responsible, but also creates this great sense of simplicity and certainty that a lot of this very generation that you described craves. The fact that they are unable to borrow money to buy a house is as often a function of lack of credit history as it is a lack of access to credit, because they tend to opt out of credit cards. They tend to not borrow money because they don't understand exactly what the cost of money will be.
We talk to big companies like JP Morgan, for example, and they say that they're increasing their lending standards and their underwriting standards because they're worried about how late we are in the business cycle. What are you doing with your underwriting standards, your lending standards, to make sure that more often than not you're making money versus losing money?
Our underwriting standards have always been the same. So we're not, again, because our business model fundamentally depends on responsible borrowing, responsible repayment from our consumers, we don't have the luxury of saying, hey, good times right now, let's sell dollar bills for 85 cents and make it up in volume. It just doesn't work. It generally doesn't work in lending, but it doesn't work for us. We don't make money on late fees. We don't make money on hidden fees. We don't charge anything but what we put on the original price. That said, you have to react to economic factors. You have to monitor macroeconomic scenarios, sort of read punditry, and The thing that you do fundamentally, though, as a lender, you run what's called stress tests, and you can do a good job with it, or you can kind of fake it. We pride ourselves, certainly that's part of my background. We're very, very, very serious about risk management. The internal sort of guidelines around what happens to our book, what happens to our company, if overnight we go into an '08 style crisis, half of the '08 style crisis. And so we run those simulations all the time. Take that governance extremely seriously, and in many ways, I think people that are confident in their risk management, ever so slightly somewhere in the back of their head think, let's see that crisis come. We'll find out who's swimming with no underwear on. And so as the tide recedes of plenty of money available to everybody, there will be some companies that will find out that they're not as good at risk management, and we feel very confident, but ask me again once the next crisis comes and goes.
Well, I want to talk sort of about going back in history, and I'm thinking of the dot-com era. You just recently went through another equity raising round. You raised about $800 million.
That's all in. That's an aggregate.
An
the
aggregate.
Most recent round was about $300 million.
Thank you. In aggregate. How has the fundraising environment felt for you broadly within tech? Does it feel like we're getting ahead of ourselves? We've talked a lot about money being thrown at these private companies that are unprofitable. How does it feel right now, the environment?
The experience I have is the only one I can really honestly speak to, not because I don't see a lot of other funding rounds, but because at this point, despite the fact that that's what gets all the news, there's not that many companies getting these lofty valuations and being thrown at these hundreds of millions of dollars. So there's not that many data points. There's still a lot of sort of their unicorn has now been modified into other kinds of corns, but quad corns. Anyway, so I think there's plenty of funds that are still trying to find great opportunities to deploy capital. Obviously, these late stage deals are complex in a sense that, on one hand, the investor says, you know what, I got $100 million burning a hole in my pocket, and I want to give it all to you. If you sort of think back to sort of Sand Hill Road, Silicon Valley style investors, that is not what that group of people knows how to do. That in some cases, that's the size of their fund. Like $100 million is not a single deal, it's 10 deals or 20 deals. And so these are very, very different situations. And as a result, it always feels extremely tenuous where somebody comes in and says, looks amazing, looks fantastic, very excited. And the last second they say, yeah, but I'm going to put one $100 million deal or $500 million deals to work. Maybe not this one. So it felt great when it was done. It felt challenging when we were doing it. And then again, we were massively oversubscribed. There were lots and lots of people standing outside the door saying, please make room for us. So in the end, we felt that we did a pretty good job marketing the equity. But I think the funding environment in general, if you squint hard enough, you can see that it's softening. I think things are coming to a little bit of I wouldn't call it an end, but as everybody reads more and more about how the economy isn't quite the sort of steamroller that it used to be, that there's talk of Fed cutting rates to re-stimulate growth, that inevitably plays itself out all the way down to very small equity investors, very large equity investors. They all kind of say, well, maybe the price will come down a little bit. Maybe I can just hang on a little. So if the deal is especially attractive and people are very excited about the company, they ultimately don't wait and invest. And if it's on the bubble, the odds are slightly lower now.
How does that trickle down into your business in terms of the pressure to be profitable, and then arguably the exit strategy could be an IPO, and you've seen a lot of IPOs that are not profitable. Yep. When do you start to feel that pressure? I
feel like there's sort of three questions in there. So
I'm hitting you all at once.
I just want to make sure I remember them all. So I think the pressure or the sort of the impetus to be profitable for us is slightly more nuanced. So as a lender and as a non-bank lender, which means that we borrow money on the back end to lend it to the buyers that we have to help our merchants sell more things, because the business model is fundamentally dependent on good, high-quality repayment, we must run a profitable book. Like at our scale, at this point, it's billions of dollars of volume per year. You can't go to someone and say, I'd like to borrow $1 billion, and I'm going to lend it all out, and I think I'm going to get about $900 million back. Like, that's a great way of getting a door slammed in your face. So And not only can you not tell that story, you actually have to show up and say, I've been doing this for 7 years. Every time we put $1 out or $1,000 out in a form of a loan, it comes back and with interest. And so it's the book itself, the lending business inherently has to be not just a little bit unit economic positive, but quite significantly unit economic positive, which is also where the stress testing comes in, where you ask the question, well, what happens if the unit economics compress because the repayment suddenly shifts negatively? So you have to have enough, and of course it's a fairly competitive market, so you can't have enormous amount of margin, otherwise somebody will come in and undercut you. But fundamentally you have to run a profitable book, and merchants we partner with also have the same concern. They want to make sure that we live through the cycle and remain there as a lender for them or for their buyers. So in that sense, it's a bit of a responsibility circle, but we ask our borrowers to be responsible because we have to be responsible to our lenders and fundamentally run a sustainable business. As an overall entity, we can choose to invest more or less money in expanding the company, and so profitability at the corporate level or sort of as an overall entity is something that you become more and more aware of as you try to go public. So to your next question, fortunately, we're not quite on that track just yet, although I generally believe that going public is a healthy thing. I think Silicon Valley is split into kind of a people that believe that going public is a terrible idea and you should always stay private and you should be sort of hidden under a rock. I think there's some truth to the distraction and annoyance of things like public markets and potential activist investors and all that good stuff. It's healthy for your shareholders, your early employees, your equity investors to have liquidity. And I think if you kind of just ignore that, you're asking eventually for trouble. So I think that's in the future, and hopefully in the future of most companies, because the other part of why I think stock market participation is a good idea, you're fundamentally opening the gains of your company to retail investors. Like part of what makes US what it is that there's access to these great innovative companies for retail investors. Like certainly not everybody, but if you are public and you're doing great, a retail investor, sort of mom and pop investor as they call them, can participate in your success. If you're hiding under a private rock, you are hoarding all those gains for your Silicon Valley venture capital and your late stage finance.
How cyclical is your business tied to the retail market? You mentioned some of your customers are Walmart, or David Yurman, for example. I'm thinking retail, and there's been a lot of discussion about the death of retail, and everyone's going to Amazon. So I wonder, how cyclically are you tied to their performance for your business?
We're actually counter-cyclical in a sense that if the times are great, people feel they just want more clarity when they have access to credit, which we provide in spades. People tend to spend a little bit more, and we add a lot of value to our retail partners. In a down market, people tend to borrow a little bit more, and the responsibility is on us at that point to make sure they don't overborrow. But we see as part of our mission to make sure people have very clear understanding of what is and isn't healthy for them to borrow. And again, not making money on late fees, not making money on kind of hidden financial tricks kind of pushes us to do that. We don't really have a choice in the matter, and we like it that way. So in general, we are probably one of the few companies that will, on the margin, not see a significant reduction in demand for our services during a downturn. Obviously, we may have to choose to tighten our credit underwriting or not. I'm fairly sure that the rumors of retail apocalypse have been greatly exaggerated. We also partner with folks like Casper and Warby Parker and Peloton. And if there's one thing they're doing is expanding into physical real estate, a lot of what they do now is very different from kind of a profit per square foot calculation that you're very used to, big box stores and places like that. And so I think the idea of always be where the customer is, give them a chance to touch it, give them a chance to fall in love with the brand, let them try the product in person is never going away. There are things that you buy on Amazon because you can get them shipped the same day, and I think that's something that we've all gotten used to and are very excited. When I run out of batteries for whatever kiddie device that my kids need, I try to get them same day from Amazon, and it's wonderful, and I thank Amazon for it. If I want to buy a toy that I will later on power with that battery, I kind of want to see that my kids might like it. And so as often as not, I find myself going to a physical retail location. And that's kind of the obvious example, things like Casper or Peloton in particular, which is a hybrid business model where you buy a bike, which you definitely want to try the thing before you really get it, or at least you might want to, and then you end up with a subscription, which is sort of how the business really sort of keeps you engaged and profitable. I think those things will end up inventing new retail models for physical retail that are completely different. So my guess is the mall concept is not going away, but what you see in those malls will change pretty fundamentally.
In the news in the last few weeks, at least with regarding big tech, it was antitrust probes and breaking up the big four. Is the threat of legislation or regulation your biggest headwind?
We're not quite big enough. We're not in the big four. I'm not sure we're even in
I just mean
big 10
legislation that could trickle down to you.
I just want to make sure that I don't overstate my. I'm already big four in my head, but we're
Dream big.
2 more years. I think. I think the concern is real. I think Congress has shifted its stance on, all those really clever kids in Silicon Valley. They can do no wrong to what have they done with my private emails and what have they done with my, the things that I said in full confidence to my voice assistant. As far as I'm concerned, I think the idea of breaking up big tech is pretty badly misguided. I think that's a fairly awful idea. I'm a big proponent of, in general, not just in big tech, but certainly in fintech and in finance. I think if you didn't have regulation, you would have short-term, overwhelm long-term benefits. If you look at some of the things that, things like, Consumer Financial Protection Bureau has had its fair share of controversial decisions, but in general, if you sort of analyze their decision-making and sort of what they said is good, what they said is bad, and what they did about it, it was fundamentally about trying to guide the market, which I believe should be used to settle, most problems should be settled by the free market, not legislation or regulation. Regulation is very helpful when, in a short term, bad things are happening, and everybody believes that in the long term it's going to be okay, but it's not right now, and real people are getting harmed. That's what regulation is for, and I certainly am a big fan of that. Breaking up big tech outside of sort of, maybe these companies are doing things that aren't untoward and they need to sort of be taught a lesson or the wrist needs to be slapped. Breaking them up, though, fundamentally sets them up for an extremely unfair fight, not in their favor, on the world stage. There are plenty of other countries, one kind of across the Pacific Ocean, where there is no danger of Tencent's and Alibaba's, et cetera, being broken up. And every one of these companies is now coming into the world stage saying, well, we have a lot of might, and we are generally interested in expanding outside of China. And so that's just one sort of aspect of the worldwide competitive situation. So if we say, well, great, what we're going to do is we're going to chop up our companies into tiny little mini companies so that they can go compete with these behemoths on a world stage, guess who's going to win? So I think it's pretty important that we allow those companies that succeeded and grew to this enormous scale, Google, Facebook, et cetera, Amazon, to continue competing, but it's equally important to make sure that it's not entirely unfettered and there is some regulatory framework that allows them to, or requires them to behave in a long-term good.
So we're almost out of time, and this is my first time, but I hear we do this thing called overrated, underrated, and I want to pose this question to you. So I'm going to give you a word, and I want you to tell me if it's overrated or underrated.
Okay.
Credit cards.
Overrated.
Overrated.
The rates are too high.
The Consumer Financial Protection Bureau.
Underrated.
Under. Blockchain.
Technology underrated. Products, crickets.
Okay. JP Morgan.
Ooh.
See, we're not the opening act. This is the act.
This is the act. Probably underrated, actually, but that's mostly contrarian. I'll spare you the chain of logic there. But,
The IPO market right now.
overrated, and I think it's coming out to roost pretty quickly at this point. I think every IPO has been an exercise in a roller coaster.
Finally, tech valuations.
Overrated, for sure.
Okay, good. Thank you. Thank you for my panelists, Max.